Hi everyone, welcome back to another video. Today I am going to discuss two AI companies. One is a AI SaaS company and another one is a fintech company. I'll go over on what they do, why they are very hard to copy, how do the numbers look like, how they are growing, and what could these companies be worth in the next couple of years, and what would be my price targets in a low, middle, or high case. Both of these companies are quietly growing, whereas everyone is focused on the AI stocks. So let's jump right onto it. All right. First company on the list is Zeta Global. Zeta Global is a AI marketing calls itself as the AI marketing cloud. And what in simple terms it does is you can look at big brands like any other CPG companies, big banks, insurance companies, airlines, retailers. These guys pay Zeta to figure out who's about to buy something and then reach that person during the exact same time across multiple different connected engines such as CTV, social, or any other marketing channel on the web. The engine is what matters. Zeta owns a proprietary identity graph covering about 245 million opted in US consumers. These are consumers that have opted in to receive and accept marketing related content. So there is no privacy restrictions or every aspect coming into place. Now, these consumers have multiple behavioral signals, and these guys refresh these signals every single month, and that is one of the most important aspect of their business. And recently they have also launched Athena, which is essentially an agentic layer that sits on top of the platform. And in the very first week of what they launched this for all their users, they drove more than 7 times the overall interactions, and it almost made about 60% of the platform usage. So it's a strong way to say that the products that they are bringing to life is are extremely good and the market is liking them. Now let's dive into what is the moat here. And it's one of the biggest moats that I feel this company has. So think of it like Adobe and Salesforce. They are essentially just a SaaS provider, but they don't own any data. Now, if you strip out Adobe or Salesforce from a company, it is going to be very difficult for the company to operate because they have been used to operating on that platform for a long time. So it's a short term pain. It's going to be very painful, but it's not that the company can't get over it. That's not the case with Zeta. If you try to replace Zeta, the data that Zeta owns and all the signals that it has goes away. And that is the moat, which is why I said the identity spine that they have is the moat. And if you strip Zeta away from your marketing aspects, and these brands wouldn't want to do that, especially because these guys are not only performing, but if you do that, you take away all this data that you have, and that's how you are reaching. So Zeta owns its data and the data constantly compounds. So let's go through how the flywheel works. They own the data, number one. Second, the AI that they have uses that data, predicts, and then it activates the campaign across multiple different channels on the web. And then from that activation layer, it understands what worked, what did not work, and it learns, and then it goes back to that entire model. And this is the flywheel, that's why it keeps improving. Now, the second layer I want to add on is the switching cost, as I kind of highlighted about it. Zeta's net revenue retention was 128% in 2025. This was essentially saying that the clients that they have with Zeta spent 28% more than they did before. Now, big customers like these banks, retailers, they on an average spend $1.7 million on the platform, which is up again 21% year over year. They have about 189 customers paying 1 million plus a year. Again, almost 20% year over year growth. And they have beaten 19 consecutive quarters of beating their estimates and raising guidance. This is very strong. These are very strong numbers from a company. Okay, now let's look at their earnings of Q1 and let's understand. So, these are some phenomenal numbers. This is Q1 of 2026. Revenue grew 50%. Their expenses, operating expenses, were up 48%. Their loss from operations started to come down. The net loss is again 39% smaller. Their EBITDA is 42% and free cash flow grew by 48%. So these are some extremely strong numbers and they are almost at an inflection point where they're getting gap positive. So they're about to get into that profitability loop, which they've already done, but it's just the beginning. So here is my low, middle, and high case for Zeta. Keeping where it's trading today at 23 times earnings, I think this is a fair value for the stock. The middle ground is at 30p and then high is at 35p. I feel with the company growing at this pace, these are again very conservative numbers. They are expected to grow their earnings per share 24% next year. With the growth rates they have, the PEG ratio is just like under 1. This is extremely cheap for a company growing 30 to 40% year over year and about to get into multiple profitable quarters. I feel this company is very undervalued. Again, my numbers are very conservative. The average Wall Street analyst price target is about $30 or $28. And if they hit the next year's $1.15 of EPS that is being projected by the company, this adds 24% more to each case, which means if they hit the numbers, then this company is extremely undervalued. Again, not financial advice. Please do your own research before investing. I do have Zeta in my portfolio. If Zeta gets around $17, I will add more. Right now, my average price is about $16. So if it gets to around $17, $18, I will continue to buy Zeta. Alright, let's move on to the next one. The second company on the list is Pagaya. Pagaya is a company that is very harder to explain to a normal person, and which is why it is kind of cheap right now. Here is a simple way to understand Pagaya. When a bank or a fintech company declines a loan application, Pagaya's AI takes a second look at that loan, approves the good one, and funds them with institutional money. That's the simple way to put Pagaya. There is multiple different lending partners that Pagaya has. They have banks, fintechs, auto lenders. This year alone, they onboarded multiple different fintechs like Upstart, Sezzle, FlexPay. And that's where Pagaya's moat is their underwriting engine in the center. So let's go through a simple step. So step 1, a borrower applies at a bank or at a fintech, any company that you look at. Let's say the borrower does not get the loan from that particular bank or the fintech, and it declines. But then that bank, because it's a partner, or that fintech sends that to Pagaya's AI because they are partners with Pagaya. Pagaya's AI underwrites the entire loan again with all the proprietary data that we have on the US credit databases, and then their AI runs through it and says yes if it's worth saying yes. Simple. And then institutional investors fund it. So that's the model. In simple terms, Pagaya is turning wasted applications into fee revenue. How does Pagaya earn money? Is they earn money from the institutions as well as from the lender. So they earn money on both sides. Lender pays them a fee for turning their rejected applications into something meaningful, and institutions pay them a cut for getting for proving them that these loans are good enough to be funded. So they get a cut from both sides. Essentially, there's no marketing cost that Pagaya has to deal with. They spend $0 on any consumer acquisition cost. That's huge, and they have had 6 consecutive profitable quarters with gap earnings. They recently posted Q2 results and they were really good, and I'll go over it in more detail. So this is what Pagaya does. Now and this is their moat. Their moat is that they don't have any customer acquisition cost, but their AI and the database in the center, their model is their moat. So it cannot be replicated that easily. It's a two-sided lock-in. Lenders won't leave, and even institutions trust Pagaya because it carries AAA ratings from two major credit rating agencies. So this is not something that someone can copy overnight. It takes a long time to build this kind of network and the moat. Now let's dive into the numbers of what Pagaya recently reported in their Q2 earnings. Their total network volume grew 33% year over year, which means in $2.6 billion in last year, to the total number of loans that they have, total amount of loans that they had gone through their network, and that now rise to $3.5 billion. That's pretty high. Revenue increased 19%. Their operating income grew by 87%, net income by 172%, their earnings per share 145%. These are some phenomenal numbers for a company that is just priced so cheap. This is something that you don't get to see often, and it will not last for long. Based on these numbers, here is my bull, bear, and middle case. I feel it's very cheap. Again, my numbers are extremely, extremely conservative, but I still feel even at this current P of 12 times, it's extremely undervalued. The PEG ratio is priced as if the market is feeling that the company is not going to grow at all. And with the kind of EPS growth that the company has, it is priced extremely cheap. I do own Pagaya in my portfolio, but again, this is not financial advice. You should do your own due diligence before making any investment. But here is one thing I'll say. The only risk with Pagaya is that if the macro environment gets impacted, as if there is higher unemployment or interest rates are high, then that's when Pagaya can get impacted because they are into the business of loans. Now, if the economy is not strong, then their business will also be impacted. But even in this kind of economic environment over the past year or two, with high interest rates, they have done phenomenally well. So I feel the market is really not paying attention towards Pagaya. And I feel these two companies, Pagaya and Zeta, They are amazing companies at good prices, but do your own due diligence before any investments. Thank you. This was not financial advice. I hope you enjoyed it. If you did enjoy it, please share, like, comment, and subscribe for further videos. Thank you.